Hello, everyone. Thank you very much for joining us today. My name is Corey Daharsh. I'm here with Advanta IRA, and our educational webinar is how to invest in litigation financing in a self-directed account. My guest speaker today is Patrick Grimes. Patrick is the CEO and founder of Passive Investing Mastery. I've got his contact information here, so you could take that down if you want to reach out to Patrick directly or check out the Passive Investing Mastery website. Patrick, thank you very much for joining me today and providing some insight into this very unique investment strategy and investment class for our self-directed investors.
Glad to be here. We do a lot of business together, and I'm excited to be talking to your audience about a kind of a unique and novel asset class.
Awesome. Well, this is a topic I don't think we've really ever covered in this educational webinar platform that we do. So really excited to bring some new knowledge to the table here. Just for the audience, I'm going to cover a brief description of Advanta and self-directed investing, and then I'm going to turn it over to Patrick for his portion of the presentation. So just to get us kicked off, if you're not already a client of ours or just finding out about Advanta, we're a full-service self-directed IRA administrator. We've got about 15,000 active clients, about 3.5 billion in assets under administration. All of our clients' funds that are not actively in an investment are insured with FDIC institutions, so the money is safe until you actually choose your own risk and choose your own investment you'd like to place it into. And every one of our clients also has a dedicated client account manager assigned to them. That would be your direct point of contact for any questions, concerns, strategies, investments you want to fund. So that person's going to help you with kind of white glove customer service if you ever need anything. We don't have a call center where you have to explain who you are and what you're trying to do to a new person every time you want to reach out. Right. Brief disclaimer from Advanta's side. I know Patrick has his own disclaimer as well. We are a full service self-direct administrator, like I mentioned earlier. So we're not a fiduciary or financial advisor. We're not allowed to convey any tax advice, legal advice, or financial advice. So make sure that as you're deciding what investments to do with the self-directed account, you're doing your own due diligence, you're building your own team of CPAs, attorneys, tax advisors, etc., so that you're fully comfortable and confident when you decide what alternative investment you might want to make. And this content is strictly for educational purposes again. So what is a self-directed IRA? It's basically an IRA with a company that's not a fiduciary or a financial advisor, like I just mentioned, that lets you invest into pretty much any asset class you would want to outside of what you're familiar with those fiduciary companies like stocks, bonds, mutual funds, those types of things. So I've got a number of different asset classes listed here just for reference, but basically anything under the sun that is not a fiduciary type asset is something you could hold in a self-directed account. The rules for these types of investment
to the list by the end of this.
I'm sorry, Sid.
We're going to need you to add legal to that list at the end of this webinar.
Oh, that is true. I'll definitely get back with our team and make sure we update that on the template. So if you haven't heard about self-directed retirement investing, that's very common actually. Don't feel left out. Only about 4% of US-based retirement accounts are self-directed right now. And that's an industry with about $40 trillion in it. So only about 1.5 trillion or so of the whole retirement account industry is being self-directed. So not a lot of people know about this simply because they're already with fiduciary IRAs or custodians, and those companies tend to lean on the side of making you think that this is too risky of a strategy or too volatile, whereas, I mean, the stock market is about as volatile as it can get, and to say it's too risky is to say that you shouldn't trust yourself and your own judgment and your own due diligence in the assets you want to invest into. So we're out here doing a lot of educational content to try to bring awareness to the self-directed space and help people understand that the power really is in your own control with your retirement dollars and your savings. There we go. So again, why do people choose to self-direct? They find it as a new source of capital. So they're already doing some sort of investing and they realize that they can use their retirement funds to add to that investment strategy. They get fatigued with the stock market. As I just mentioned, it's pretty much been a roller coaster ride the past 5 or 6 years. And then the tax benefits of making these types of investments outside of your personal savings and with a retirement account you're generating either tax deferred or completely tax-free earnings based on if you have a tax deferred or traditional account or a post-tax or Roth account. So there's some great benefits to any of those options. Those are the key reasons we see people switching over to self-directed accounts. So really briefly, I'm just going to go over a quick explanation of the rules. Again, you can invest into just about anything under the sun with the self-directed account. The only limitations are hard to value assets. So anything that is subjective in value, like antiques, fine wine, artwork. There are some coins that are allowed to be invested. So precious metal is an asset class you can do, but there's limitations to that. And then the only other way that the IRS limits these accounts are by labeling certain individuals close to you as disqualified persons. So that's going to be your family members on your lineal tree. So your parents, your grandparents, your children, your grandchildren. You're not allowed to transact with those individuals. That also includes your spouse, yourself, obviously, and any businesses that these individuals control or own or make day-to-day decisions for. So that is to say, you can't make an investment where the person you're doing the deal with on the other side of the table is a disqualified person. Otherwise, pretty much anything else you could think of that you would want to talk through a strategy with an account manager, you could probably find a way to do with your retirement account. Here's a quick chart. I'm not going to go into it in detail as I just explained it verbally, but the disqualified person list. Keynote, your siblings and your aunts, uncles, cousins, other distant relatives are not disqualified persons. So you can transact with those individuals. Just make sure it's not the main trunk of your family tree that you're looking to do a deal where you're buying or selling an asset from or with or something like that. And without further ado, I'm going to go ahead and turn it over to Patrick, who's going to cover the litigation finance side of today's presentation. Patrick, I see you've got your cursor there, so the floor is yours. Thank you.
Great, and thanks so much for the intro. We have about a third of our investments would come through self-directed accounts in our affiliate funds. So a lot of work with you, and I am a card-carrying member of the self-directed solo 401k variant of that. So I definitely appreciate what you guys are doing and encourage everyone to dive in there. It's a great way to go. We're going to talk a little bit about alternative investments today. We're going to start a little bit higher picture. I'm going to do a little intro first on who we are and who I am. And then we're going to back out and say, why alternative investments? Why do you need to call Advanta and say, look, let's get some of my cash out of the stock market and my retirement accounts, and let's get it allocated into some alts, which traditionally with normal custodians can't go into alternatives. Be important? How much are individuals putting in alts? Then we're going to dive into what litigation finance is. So we've got about 40 minutes. I love to be interactive. So if there's any questions, I've got the chat box right here, and I'm excited to layer those in as they come in. So make sure that this is really for you. I'm here for you. So make sure that you're asking whatever questions come to mind. And I've got it here handy. If there's any that I miss, we'll get to it at the end. Please let me know if I've missed it. But see if we can get this first slide going here. We can try the arrow key maybe. There we go. So Passive Investing Mastery, which is the company I founded and I'm the CEO of, we believe in education. We have both an educational platform on alternative investments as well as a platform that allows us to sponsor investments. Our mission is to educate investors to achieve mastery in the art of alternative investments. That is what's very exciting for us. We have best-in-class alternatives within our company that we provide, but we also encourage a diversified portfolio of alts. It seems to be advancing on its own. I'm not sure if that's happening on my side or what's
I am
creating.
not touching anything, so I don't know how I'd noticed that as well.
Okay. So we want our investors to be able to find a path to not just financial independence, where you're secure in your investments, but financial security, which means you're in a lot of different investments which are non-correlated to each other, and we'll dig into that in a minute, so that you can contribute to the causes you care about most. We have a disclaimer here. This is not an offering to sell a security. This is purely just for information and educational purposes only. All our investments are offered to accredited investors only. And I'm not a financial advisor, an attorney, or an accountant, so this is not financial, legal, tax, or investment advice. We recommend that you meet with your team of professionals before making any such decision. Let's see here. So who am I? Patrick Grimes. I started out as a machine design, automation, robotics engineer. In fact, that little machine in front of my forehead is Tesla's rotor assembly. It's a robotic assembly cell that takes the magnetic stamp of a rotating part of the Tesla motor and puts the copper bars in it. Right behind my forehead is a Lockheed solar cell satellite assembly machine, and in my chin is actually a flu test machine, which is pushing out over 100 flu tests a minute, and that was converted to COVID diagnostics tests during COVID. So done a lot of really interesting stuff as an automation robotics engineer. I did well early on. So I decided, where am I going to invest? I got some advice early on to invest into alternatives, more so in real estate, by the founder of the company I work for. He actually said, no, don't go invest in these stocks. Put everything you can as soon as you can into alternatives, into real estate. And his only regret, although he's a titan in the high-tech robotics industry, his only regret was not investing more sooner into real estate. So I just went snot-nosed engineer, all in on the highest returning deal I could find, which was a pre-development, which is in that picture. And then I lost everything in 2008. I wasn't conservative enough. I was, obviously a lot of people lost some money then, but I learned my lessons early. Was still a very talented engineer, got a master's in engineering and an MBA. Started getting bonuses again, found my way back to investing through single family, traded up to larger apartment buildings. And then from there, started writing books, started succeeding in alts, write for Forbes. I got about a dozen articles in Forbes, got a couple best-selling books out. We offer those for free on our website. And we did some energy, and then we developed a company that was focused on a well-balanced portfolio in alternatives. And keep going here. We have the income fund, which is a real estate asset-backed debt fund, which is great for IRAs. It has a combination of short-term and long-term investments. We also have an acquisitions fund. The acquisitions fund is providing for the opportunity to win from the upside of the downturn, to buy things with all cash right now, that downturn being in commercial real estate. So we're doing incredible things in that space. And we also have litigation finance, which we're going to go to in a minute. But this is our whole team. So that's a little bit about who we are and what we're doing in our mission. So let's dig into why alternative investments. And what I've told you before is that, man, I lost everything once. And it's important to know when to prepare for market volatility. And quite honestly, the answer is always, because there are, John Gibraltar here, Kenneth Gibraltar says, there are two kinds of forecasters, those who don't know and those who don't know they don't know. So really, it's always important to be preparing for a downturn. Man, when I was starting in real estate, everybody said, "Oh, it's never going to go down. Everything's going great." And all the track records of the sponsors and the developers I was working with were almost perfect. This is a shoe in. But what happens? Cycles happen, and you never know when that's going to happen. 14 of the last 11 Fed rate hikes, 11 of the last 14 Fed rate hikes ended in a bust. So while it's always important to think about diversifying, not into just stocks, not into just real estate, but into different kinds of investments outside, maybe lesser known novel ones. Well, it's always important to be doing that, so you're not riding the same wave. It's especially so now, given that we just got done with a Fed rate hike. We have a trade war going on. The world's biggest economies are betting against the dollar, and our spending is out of control right now. So there's a lot of indicators, even unique to past things, but making it highly probable it may be in uncertain times. So how do you prepare for those uncertain times, whether it be today or always? Well, Morgan Stanley publishes some information about balancing traditional investments and alternative investments. And if you have your IRA sitting in, you're still your employee managed custodian, it's pretty much entirely in traditional investments. Even so, if it's in a REIT, I'll talk about that in a second. And what does Advanta allow you to do? It allows you to take some of that and put it into a self-directed account to go into other alts. Morgan Stanley talks about 25% in alternatives, what they recommend, and that improves your risk profile. It reduces your dependency on the public market fluctuations, lowers the volatility, mitigates downturns, and it provides new ways to drive profitability. And so you can literally get a higher return at lower risk with a more balanced portfolio. So let's look at some of these data points. Look at Edward Wolf here. We're going to compare some of these. And so you've got kind of the middle class, you've got the upper, and you got the higher income. Where are they allocating to? And you can see like the liquid assets, the pension accounts, the principal residence, man, in the middle class, you're looking at like 62% in the principal residence, right? But if you look up into alternatives, which is at the very top, about 7.9%, it's very little. You get to the higher net worth, you're already to 25%, right? So you already made a big jump. So you really want to start looking towards who are those people that are succeeding and how are they allocating. The ultra wealthy are at 50% in alternatives. 50%. So how much is your portfolio? If you did your pie chart today, what is that alternatives? And inside of alternatives, you have business equities, private equity, you have real estate. Here's Tiger 21's index. And you can see there's real estate at 27%, there's private equity at 26%. So we do a lot of real estate. I do a lot of real estate, but that is not the end game. That is one step, that's one foundational pillar in a well-diversified portfolio where all the different investments that I have don't ride the same market fundamentals. They don't ride the same waves. And you can see, here's Tiger 21, which is a renowned, large, ultra wealthy group in the country. How do they allocate? Well, 26% in private equity and 27% real estate. I know a lot of people that have nothing in real estate. I know a lot of people that have everything in real estate. So you got to find that balance. Think like hedge funds, think like private equity firms, think like sovereign funds, think like the sophisticated people that build portfolios to last. So we're setting the stage here, if you can understand, about why alternatives. So you really need to seek non-correlated alternatives. These are the ones that don't rise and fall together, or counter-cyclical ones that intentionally rise when others fall to balance out a portfolio, right? So let's take a look at some examples of those. First, I want to talk about REITs. There's a ruse of REITs because you may be talking to Advanta and they're saying, hey, you need to get into real estate. And then you may say, well, actually, my financial planner has my stock portfolio in REITs, so I'm already hedged in real estate. Well, no, you're not. The whole point of getting into what we call a diversified asset isn't just to have a different name of an investment. It's actually to have different fundamentals of that investment. And so me, as well as many others, thought I was diversified. REITs are mistaken as real property. That is unfortunately not the case. They lack the benefits not only of being delinked from real property, but they lack the benefits of depreciation. They lack direct hedge against inflation, and they lack the security of a real asset because they behave like a stock and they're subject to the stock market sentiment. So let's take a look what that looks like. Here is a graph of a REIT and S&P versus real property. And you can see the REIT is the gray and the S&P is that brown. I could probably do better on the colors there, but they correlate exactly together. Exactly. It's insane like how close they are, sentiment driven, because a REIT truly is paper. It is not real property. And the S&P is paper, and REITs are traded on the S&P. So you cannot say you're diversified in a REIT because the diversification means you have to be in different market fundamentals. If you're in the same market driving the same ups and downs, you're not diversified. So what are alternatives that do provide true diversification? There's oil and gas, there's gold, there's technology metals, there's gold, there's storage, there's ATM machines, there's Forex. Very interesting, right? There's housing. There's plays. I have some friends that are investing in Broadway music theaters. There's agriculture. There's EV vehicles. There's apartment. There's a lot of different options out there. How do you choose these kinds of options? Let's look at when you're taking a look at the makeup of your portfolio. I'm a big metals guy. I appreciate foreign allocation of my portfolio metals. Why is that? Well, gold's traditionally a safe haven, and it's doing really well right now. It wasn't super popular 10, 20 years ago, but it was still a safe haven, and it was still provided non-correlation to balance a portfolio. Turns out it's inversely correlated to the stocks during crises and the US dollar. Well, are we headed into a crisis in stocks, and is the US dollar taking a hit right now? So if you have a bunch of cash and liquidity for emergency reserves, perhaps taking a piece of that and putting it into cash equivalent in gold would make a lot of sense, wouldn't it? Because that would help counter-cyclical. Let's look at that, what that looks like on a graph. So here's gold and the S&P, right? Gold is higher when the S&P is lower, and the S&P is higher, the gold's lower. So they're counter-cyclical, right? They help to balance out your portfolio. So here's gold versus the US dollar. Couldn't be more predictable. So they're clearly counter-cyclical. And when the dollar's strong, gold's a little lower, and it trades. This is called the counter-cyclical. This is how you balance your portfolio out. So I keep much of my emergency reserves, my liquidity on hand, in gold and silver. Let's talk about oil and gas. It's a really common one. And I do have on my website Patrick's favorite alternatives to balance a portfolio out. Anybody can invest in a day to balance a portfolio, and I go deeper into all these. The low correlation with stocks, what does that mean? It means it's not non-correlated. It just means they're going to ride waves, just like how the stock market and real estate, they kind of go up and down. They're not necessarily linked, and you can't really build a correlation. Well, oil and gas have low correlation with stocks, right? So that means they're a good diversification play. They provide a hedge against inflation and stock volatility. Because, excuse me, I got a little bit of a cold this morning, and it's super early here in Honolulu. I think the sun's still coming up behind me. So it provides a hedge against inflation in stocks. So it's a good diversification option if you've got a portfolio that needs a hedge against inflation in stocks. Most of us do. There's really risky ways, working interest ways with huge ordinary income, or there's mineral rights. There's long-term cash flow that aren't quite as risky. It is a commodity though, and it's higher volatility. So you're investing there for more stability in your portfolio because you're not all in one foundation in one market. And as you do that, as you add more pillars, your portfolio becomes less risk, not because each individual investment isn't necessarily lower risk, it's because your portfolio becomes lower risk. So here's an interesting factoid. I haven't seen many questions come through. I've seen a few. Maybe somebody could jump into the Q&A right now and let me know. And if you see any questions coming through, let me know as well. But let me know if you think gold and oil and gas are correlated.
Just for the audience real quick, the questions are on your GoToWebinar panel. There's a box labeled questions. That's where Patrick's referring to that you can about. I believe we mentioned that, but just to make sure everyone knows how to access and utilize that feature.
Is it chat or questions?
It should be under the one labeled questions.
Okay, you may have to team me up for those because I don't see questions. I see just a chat.
Okay. There's a few that have come in.
Yeah.
Go ahead.
And so what you find here when you see something like this is you got to kind of look, well, wait a minute, it doesn't make sense because gold's something completely different than oil and gas. They're not the same thing, right? So how could they trade so tightly? Well, it turns out because the market fundamentals of gold, as well as the market fundamentals of oil and gas, come from certain nations where the majority of them are produced, that they tend to actually correlate. And so it's important to know in situations like this, what aspects of your portfolio are correlating. So if you're purely just in gold and you're purely just in oil and gas, this is an example of why those might correlate together and you might not find true diversification. And actually looks at in the BRICS nations where the predominant amount of gold and oil and gas are currently mined is about 80% correlated. And so it's very interesting that that's the case. So keeping in mind here, having a hard time getting the slides to move. Keeping in mind here that it's important to understand and it's important to study which of these investments do in fact correlate. So let's talk about some why. So now that you've kind of established, like here's some ideas of what correlation and non-correlation are. Let's talk about target industries. So if you're looking for things that you're heavy in, maybe you're heavy in the stock market, and maybe you've got some money in with Advanta, and you're like, hey, or I got some cash on the sidelines. Where am I going to invest out of the stock market? Well, the gateway drug typically is real estate. That's a stepping stone, not the end game. We do a lot of real estate, but we also know it's important to have an allocation, as we showed. But where are your other allocations? As you saw, like where's that other 25% in alts, right? Well, they can't be correlated to the stock market. They can't be correlated to real estate, or else it's not true diversification. So you seek out what these other ones are. There's lots of options. The big ones that tend to have really good, what we call low correlation to traditional investments. Those are housing, those are energy, ones that have low correlation to traditional assets, have low correlation to interest rates. So you kind of look at what are these kind of lesser known non-correlated investments. These happen to be the ones that are highly coveted by private equity firms, hedge funds, sovereign funds. So family offices really study the makeup of their portfolio. What are they heavy in? Well, turns out healthcare is a really strong one. It not only shows very low correlation to all the other investments out there, but people still get sick in recessions. They need skilling, they need health care throughout downturns as well as good times. Education, the continuous need for upskilling and reskilling. Utilities, again, something that is very low correlated, that provides for a consistent need regardless of market volatility. Legal services is our single favorite. It's not only do you have to establish one that's recession resilient and steady, you have to figure out a way to access it. It turns out with legal services, we have a really clear way. We're going to dig into legal services on the subsequent slide, but other types of low correlated industries that are great ones are CPA firms. They're typically needed regardless of market volatility. Plumbers, HVAC companies. These are the types of things, just to get your wheels turning a little bit, that are very consistently needed and tend to just simply grow, and profit margins stay fairly consistent, and the demand tends to grow. So let's dig a little bit in legal services. Companies still need representation in recessions. There actually is arguments that legal services is countercyclical because it turns out that people become more litigious in tougher times. However, the data doesn't necessarily show that. It shows just a steady state growth. It is really incredible. This graph right here shows legal services, which is that green line. That shows all the way past 2008, a steady state incline growth of the industry. That is really fascinating because let's take a look at what oil's been doing. It has been on a wild ride. Let's take a look at what gold's been doing. Let's take a look at what real estate's been doing and the S&P. So these are not necessarily all lined up showing value. They're lined up showing variability, right? So you can see side by side how they vary in their values. So what's really interesting here is to look at this and say, look, economic conditions affect different assets differently, right? And so that's really what's happening. So you want to look at what are those economic drivers. Graph to the left, it shows there's dramatic volatility present in common investments. Legal services green shows steady growth, non-correlation, and stability. And why is that? Well, because the outcomes of cases aren't changed by market volatility. They aren't changed by the condition of the market. The awards or settlements provided to harmed individuals, they're not affected by what's going on in the market. One thing that we can rely on here in the United States of America is that rule of law, right? It's that judicial system. It's people getting awarded for being harmed, and it's people getting justice through the court system. And the global industry for legal services is like $850 billion. Do you realize that's the size of the global airline industry? That's about the size of the global airline industry. Just what we work in as mass torts, that's closer to 443. So it is quite incredible and how big this industry is. And it's sitting on the sidelines. You're like, well, I've never heard of investing in legal industry. Well, it's as big as the airline industry, the global airlines. Why not? So I'll tell you what, it is more common than you think, but lesser known with what we would say is accredited investors. I'm just trying to get the slide to go.
Sorry, Patrick, I moved the cursor to see the questions box. And when I move it, it pulls it back off screen. So yeah, you're good there.
Okay, so we just looked at some data here, and I think this is from Swiss Re. And it talks about what is the legal industry. Well, if you're looking to look at the legal industry, you're going to have to say, well, sure, it's recession resilient, it's non-correlated, and that's a great thing, but how do you access it, right? Well, you can help attorneys, for example, ones that are just like real estate operators. They're trying to, instead of acquire buildings, they're trying to acquire clients. And instead of real estate operators that need to acquire a building and improve a building to provide housing for tenants, legal operators that have a history and a track record and a huge docket, a bunch of assets, which are their client list, they're looking to acquire clients, and they're looking to, a lot of them, get them access to justice. But what happens when those clients can't afford access to justice? They are the harmed individuals that are looking for an attorney to either work on pro bono for free or work on contingency, meaning that attorney gets paid contingent upon success. So we can enable these attorneys, operators essentially, by essentially doing the equivalent in an investment in them or a loan to them, so that they can acquire clients, they can provide services to them through the court system, and then they can give them access to justice. And that is very common. In fact, the first case of this in the United States was back in 1910, when third parties said, hey, look, you're dying of cigarettes. And I think they're lying to you. I think that American tobacco has been telling you they're healthy and they're not. And these harmed people are like, oh, really? Yeah, it's probably true, because we're all dying these horrific deaths, but we don't have the money to go against American tobacco. And so the first case in America of this third-party legal funding was actually back in against American tobacco. And it goes back thousands and thousands of years to like Knights and Nobles back in the day. But in America, and it's much bigger in England and Australia actually, but in America. And since then, there has been a market for people that were harmed that can afford it, third parties that can go and fund these attorneys to work on contingency. And so how does this kind of break up? Legal funding is actually quite large. There's things called mass torts, there's personal injury, there's large business commercial litigation. And throughout the world, you can see the US now has a pretty big chunk. It's also big in Australia, Germany, France, Japan. And that kind of brings us to, what is this ability to learn? What is the PIM, our Passive Investing Masteries Platform Diversified Litigation Portfolio? And what we're doing here is we're providing investors the chance to get returns derived not from the outcome of real estate buildings, or not from the outcome of a stock portfolio, not the out from sticking a straw in the ground and trying to get oil out, but from the outcome of providing access to justice for those who couldn't otherwise afford it, getting meaningful settlements to those harmed individuals, and sharing in the contingency fee that the attorneys would receive for doing that on a contingency fee basis. And this is pretty exciting because not only is it recession resilience, right? But when we're in late stage lawsuits, these are lawsuits that are very towards the end, and there's essentially a continuum of any kind of investment. You can be in oil and gas, you can be wildcatting, right, which is super risky, and potentially get huge returns and lose it all. And angel investing, you could be investing in just ideas, napkins, literally sketches on napkins of a company, and maybe get 100x returns or lose it all. All investments, real estate, like me, I did a pre-development speculative deal in 2006 and 7 and 8, and I lost everything in 9 and 10. So you can do those kinds of investments in any industry, but also in any industry, there's things called late staged, right? Where you're maybe buying an existing development worth a couple buildings. Maybe you're finishing a couple more buildings, or you're buying in real estate or in oil and gas. Like, here's a well that's already been drilled and we're already seeing oil, and we're going to invest in that, right? It's really late stage stuff with a much lower risk. And so that's pretty much how we work on that. That's those types of cases we look at. Our litigation experience is pretty phenomenal. My partner, Dave Gooseman, he's got 15 years experience working in different kinds of cases, the ones that are inside of our fund. And these are not cases, a lot of these cases are household names. Right? You've probably heard of some of them, but spending millions of dollars and collecting billions of dollars by holding organizations and corporations accountable for their misdeeds. We're going to talk about what some of those look like here in a minute. Now, as we talked about before, what is litigation funding? We're solving needs in the legal industry. And in America, what's great about it is if somebody harms you, you have recourse. If somebody harms you and there's a wrong or injustice, that's called a tort. I mean, in Latin, tortum. means wrong or injustice, right? Somebody either wrongs you or there's an injustice, and there's a harmed party, right? And that harmed party, we call it a claimant or a plaintiff because they're making a claim or they're against a defendant, or they're making a complaint, right? Plaintiff. They can seek justice in America, which is awesome. The harmed party can sue the defendant, the person that's defending, the organization that's defending themselves, through litigation. Litigation is simply the word that is resolving the dispute through the court system. Now, when lots and lots of people, lots and lots of harmed individuals are similarly harmed by one individual or entity, or call it Big Bad Goliath, that we call a mass tort in the case that it's goes through a process where a judge says, look, there's so many of these, there's thousands. Let's consolidate, not into one lawsuit, but let's take all these individual lawsuits and let's do a mass tort. And that's different than class action because that's one lawsuit. That's a lot of win-loss. These are thousands of individual lawsuits, but let's do it in one court at once so we can get general rules around settling these simultaneously. And so why litigation funding? As I was saying, these harmed individuals, they just lack the funds to pay up front. The attorneys want to defer what they can to the end, but they can't defer at all. And they're very expensive. Going into litigation is very expensive, but we can provide very meaningful settlements, $50,000, $100,000, $400,000 to these harmed individuals. And the attorneys can receive 50%, 40%, 30% of these settlements and still give meaningful settlements to the claimants. So it's a big win for the attorneys. It's a big win for the claimants that otherwise wouldn't be able to afford it.
So Patrick, just to add to that, there's a few questions that came in here. First, relative to what you're talking about right now, why mass torts over other kinds of litigation? And secondly, what is the average return on a mass tort? I know you just mentioned kind of the side of it for the attorneys and for the claimants, but for the user that would be, making an investment in this type of thing.
Well, so we do a combination of mass torts, which are thousands of people similarly harmed against one large defendant. And we do other things that are single events, like sexual assault. We'll go into that in a second, okay? And essentially, the reason why we do that is because class action, really, it's not meaningful. Nobody, maybe the one person that filed and the attorneys are making money, but everybody else maybe gets $50 or $70 or $80. You've probably been added to one. But these individuals that we're helping, we're going to talk about it in a second, like survivors of sexual assault. And we just had a large settlement out of the LA Juvenile Detention Center that's going to pay significant returns to our investors and incredible, meaningful settlements to the harmed that we helped through that fund. Also, we'll talk about it in a minute. Like we're talking about like Camp Lejeune, our military that was drank contaminated water for 17 years, and DOJ took responsibility for knowingly doing that. Horrific deaths. They're getting between 100 and 450,000. So they're getting meaningful settlements. It makes a difference. And we're not ambulance chasers, so we're not going to go after like this kind of scraper bottom feeder. You got a DUI, call us, or were you hit in a car accident, call us. We're going for game-changing and very late stage. And so the other thing I was talking about earlier is the timeline. If you do these cases which are in a certain theme that we're in, you can get involved in them after they've gone into the courts. They've been consolidated. There's been what we call causality and liability established. There's already settlements in the same kind of case law, or there's analogous settlements, or there's even a grid already published, like in the case of Camp Lejeune, saying here's your return, here's the settlement amount for each specific type of ailment. And so by doing our specific niche, we can underwrite these, we can lend on these with more predictability, and we can make a difference at the same time. This slide here talks about, and we'll go to the returns in just a second, about the analogy of the real estate. And I basically said this before, but we're lending to legal operators just like real estate operators. There's a loan to value. We typically stick into 10, 20, 30% in the litigation space, just like how in real estate it's usually 50 to 90%. We use law firm valuation specialists to value the collateral, the potential amount of settlement that's coming through in the attorney's share of that. That's the collateral, the attorney share of that contingency fee. We use law firm valuation specialists, very similar to how real estate uses appraisers. And then we'll file a lien against the attorney in a very similar way that we do, a deed, a mortgage in real estate. So it's an asset-backed lending structure in a very similar way to real estate. If you bought a home, you understand all the steps, turns out, of how litigation finance works. So let's see here. So portfolio investments, we'll go a little bit further. I'm going to skip the steps, but those are kind of the steps. I want to make sure we get through it all. Like, here's an example of a case, and this is really going to come out. Camp Lejeune, really, this is a horrific story because for 17 years, it affected the military, their families, the civilians, the vendors that were all on site there at Camp Lejeune at a Marine base where our soldiers went to train for war. There was these Agency for Toxicology and Substance Disease Registry published all these diseases, cancer, birth defects, all kinds of stuff that were horrific outcomes of the specific toxins that were in the water. The DOJ took responsibility for it. Actually, bipartisan legislation was passed. Republicans and Democrats agreed on that the DOJ was responsible for this. The Camp Lejeune Justice Act was passed to recognize they were the cause of it and liable for it. The U.S. Judgment Fund was put in place to pay the claims with no cap or limit. So a really strong, what we call defendant in that case. And a grid was published. This is the early settlement grid saying, hey, based on how long, what your disease was, and we can look at medical records to demonstrate what their disease was and how long they were there. And we can look at their proof of exposure. We can look at how long they were exposed to verify that. Here's your settlement, right? So there's from $100,000 to $450,000. So this is a very late stage type case. It's got a really strong defendant that can pay. It's very clear what the payments are. And this is the early settlement grid. So we underwrote to $100,000 per case. But we believe in the next coming years, will likely, many of them will come in much higher. So it's a really easy way for us to establish a really solid collateral value and lend a conservative loan to value. Roundup, Monsanto. You're probably very familiar with this one. I don't know if you are, but our military, and also Paraquat is another one we're also involved in. But Monsanto, now Bayer, published EPA reports, lobbied and got these EPA reports published saying that Roundup was safe. Fast forward, all kinds of horrific illnesses, cancers, non-Hodgkin's lymphoma are being caused by the use of these. And these are, we call this portfolio land and liberty, actually, because it's the people fighting for our liberty and the people caring for our land. And talking farmers and landscapers essentially bathing in this stuff, right? And now they've retracted the EPA reports. There's been significant other lawsuits that have been won. There's precedent set for the settlement amounts, billion-dollar payouts. And so it's very easy for us to say, okay, here's their proof of exposure, and here's their actual ailment, and here's how much these guys would be entitled to. And so we can help the attorneys provide access to justice for those. And we have a couple hundred of these, a couple thousand of the Camp Lejeune, a couple hundred of the Roundup so far. Labor claims. So this is a case in California specifically where there's wage theft. This has happened to me when I was a mechanical engineer one time. I got this company. I got canned one day and I didn't know what was going on. Turns out they lost the contract. The guy tried to not pay me, and at that point it was a tune of like 20-some, 30,000. I mean, it was quite a bit for me back then. That was a huge number, and it was a combination of salary and bonuses. I've been subjected to this, and thank goodness that I was able to actually go to the labor board and get justice. But so in California, you actually have the ability to be able to collect on these. And there are people that just simply don't have the resources to go fight. And I've heard a lot of stories about this. So we do some labor claims work as well. There's also water, like the forever chemicals, PFAS, water contamination. Talked about Paraquat. We have infant baby formula in our fund as well. This is toxic baby formula that cause terrible diseases, and sexual assault, which I'm really excited to report on the settlements. Having Suboxone, heavy metals in baby food. What we're looking for is cases that have strong scientific evidence, that have already gone in and there's been expert testimony allowed by the courts, demonstrated by the courts. We have strong claimant profile, meaning these are claimants that actually have a real claim, they have real proof, they have, and that's going to result on a meaningful settlement for them. And a strong defendant. These are defendants that, these are individuals that although they did misdeeds, they're well capitalized to be able to pay these claims. And we want to be diversified across a broad range of cases and a broad number of claimants, thousands of claimants. This is where we were talking about being late stage. I won't go into this too much, but typically cases happen, maybe harm was done for 5 years or 10 years or 15 years, right? So people are like, don't these cases go on forever? Well, not necessarily. Maybe the harm happened forever, but the judicial system works in America. That's the one thing, maybe one of the few things we're getting really, really right. We're looked at around the world for that rule of law. And the typical stage for, call these mass torts, and the single event, like the labor claims and sexual assault, those usually happen in just 1 or 2 years. But typically where we're at is when the lawyers begin consolidating these cases, it may be 7 or 8, maybe 9 years before it settles. But we don't get involved then. Call this early stages. Maybe it's turned into a mass tort at one point, 2 to 4 years later. It means all these thousands of claims are saying, hey, we're going to settle them in one district, one court. And then we still don't get involved. It's probably much later on, two years past that even, where it's entered into the court systems. We've seen very clearly that there's what we call causality and liability. Very clearly, and there's conversations going back and forth, negotiating settlements. You got to keep in mind, it's not necessarily this binary win-loss, although we're highly diversified for the purposes of de-risking ourselves from loss, but 90% of civil cases settle. Right? And so the conversations are typically more about settling and when and how much, right? And so once that happens, and you can start seeing, hey, look, we've seen some settle already, there's some precedent for it, we will then become interested. We call that very late staged. And in that case, maybe we're a year, 2, 3, 4 years out, maybe we're on the outside 5 and beyond. So that's really our timeline. And in our first settlement was less than a year in sexual assault. So pretty cool stuff. So that's kind of the timeline of these.
Patrick, I have a few questions from the audience just to bounce off you. Here's one. Why would an attorney firm consider bringing in funds if they're in late stage / pre-settlement? Seems like they just push to the finish line and not bring in an investor unless it's a small percentage of the settlement.
I think it's the same argument why a real estate operator would need a lender, right? Because they're not made of cash, right? The cash's got to come from somewhere. Like a real estate operator, these attorneys have been working these cases, as you can see, for maybe 2, 3, 4, 5 years. And they've been doing it a lot on their own dime. And there's really 2 things that are happening here. One is they truly do need funds. Oftentimes they have a lot of assets. It's like an real estate operator built a building without any loans. And they have assets, but now they need funds for 2 things, right? They need funds, one, to take their the resources, and it's not complex, hourly rates, court fees, filing fees, testimony, their rent, the attorney's rent. They need funds to get them across the finish line, their current claimants. But then they realize their current clients, if I take these clients across the finish line, it's about the same effort as if I take 5 times that number of claimants. And so they may say, look, you know what, I spent a lot of money in marketing to find this 100 or 1,000 claimants. And I'm going to put in the same time and energy and effort to get them to the finish line. If you could help fund more marketing to find more harmed individuals that were similarly harmed by the same defendant, and I can tack them on to this docket, I can settle them together, and it will be about the same effort for me. But we'll give more access to justice, we'll find more people that need it, and the more harmed individuals we stack on, the more intimidating we are to the defendant, and the sooner they will settle. So we do a combination of existing claimants where we're like, okay, here's the existing claimants that they have, and we'll lend a % on that. And then we'll help them, we'll advance funds, just like how a real estate operator will advance funds for them to improve a building, and we'll layer it in and increase the collateral value of a building. We'll advance funds as an attorney runs their marketing engine, onboards new claimants, and will advance funds as those new claimants begin to increase collateral. And that's a win-win for them.
No, I think that's a great explanation. Thank you very much. One other question before I turn it back. I want to keep you on track as best as possible. You mentioned, I believe, 2 slides ago, on how a lot of these damages are long-term damages. This question here was specific to Roundup. Has Roundup been forced to change their formula to be less toxic or made any other changes due to the mass tort? So are there like future changes and repercussions that take place when these cases are settled?
As infuriating as it is, they haven't, and they haven't yet, but they're working on a new conversion, a new chemical makeups now. They've literally been making a calculation that the revenue far outpaces the cost to settle. And while these mass torts can create social change over time, it takes consistent chipping away at the profitability in order to get there. But the reason why we can still continue to collect settlements is because Roundup actually didn't change their chemical makeup. And in a lot of cases, there has been, and during discovery, they found out they did know that this farm came, and there were proposals to change in a lot of these cases. But in some of them, they made that calculated decision on a risk reward, and they've deemed it too high a risk with some of the PFAS, like for example, Teflon. That's caused a lot of forever chemical issues. They actually, at one point, during discovery, they determined that they understood some very damaging effects of it, but they determined it too high a risk, essentially, to the revenue stream to change. And so, if and when Roundup does change their chemical formula, it's going to be much harder to get help for those that have been harmed. But as of now, they haven't.
Got it. Unfortunate, but understandable. And
Yeah.
I mean, like you said, it it allows you to keep these claims going forward because they're not changing anything. It's unfortunate and borderline unethical or immoral for them to say, oh, we'd rather just pay for this than actually make the change that would be better for society and the environment. But yeah, if you're looking at simply dollars and figures like that, I guess that's the way they chose to go, or at least are choosing at this point. Sorry, not to get on my own diatribe, but back to
No
you.
problem. Yeah. So we talked a little bit about existing claimants versus new claimants just a minute ago on how we'll help aggregate these cases. We'll lend on existing lists of claimants, and we'll help lend on marketing expenses. Trying to get the slide to move. I don't know if there's been a cursor thing there. This is the Land and Liberty investment, an example of investment where we put $500,000 in to lend towards an attorney. And I'm calling it a loan because it's the easiest way to represent it. It's actually called a prepaid forward contract, just another way of investing essentially into the attorney. But for simple phrasing, a loan, $500,000 for existing claimants and $1 million for new claimants. So we're helping him, we're collateralizing all of his clients, but we're helping him give some funds to get his new existing claimants across the finish line, and we're adding more funds to help him get additional claimants. And this is split between thousands of Camp Lejeune and also Roundup. And what does this look like? It's really incredible. The estimated value of the collateral for the Camp Lejeune is $8.5 million. 4.6 million for Roundup. So if you look at sort of the loan to value makeup, man, that's over $12 million in settlements. That's the asset that the attorney has, that's in settlement value coming from that docket. And so he would say, well, I don't need a huge amount of money actually. I actually only need $1.5 million. So then we'll work out terms with him where we get a preferred position on the return of capital, and then we'll get a waterfall on the upside, but then he gets a lot of the upside. So we're actually at like a 5.8%, let's call it loan to estimated collateral value on that particular investment. That's pretty extraordinary, right? You're really down low, right, on the capital stack here with a lot of volatility up above, and that volatility comes out of mostly what we're calling the borrower's pocket, right? Sexual assault, we just had an incredible settlement. Everybody can Google right now, LA Juvenile Detention Center. Don't read it in too much. It's horrific stories, but it's great to be a part of actually giving compensation to the harm. This is an incredible win for our fund, and also not only juvenile detention centers, but also there's some hospitals and some other things in there too. But in that case, it's about a 20%, what we're calling loan to estimated collateral value. We talked about the labor claims. We have $1 million in there. We're looking at a target 168 claimants in that one. And it's split between new claimants and existing claimants, about a 23% loan to collateral value. I call it the SBCC portfolio. It's $2 million. It's a hyper diversified portfolio. So we're in a diversified portfolio, lending to attorneys that have a diversified portfolio. And we're getting a preferred position on the returns of the whole diversified portfolio of the attorneys. So it's great. If one case doesn't work out for them, that's volatility out of their side of the profits because we're at the first position on the whole diversified portfolio. Camp Lejeune, Toxic Baby Formula, Visa, MasterCard, Antitrust, Suboxone, and there's more actually within this. But those are the predominant ones that we wanted to highlight here. Highly diversified. And each of these are individual. It's not class action where it's one win-loss. Each of these are individual cases. In this particular, about 17 million estimated collateral value and 11.7 million loan to value. So we're looking for litigators that have experience, track record. We do low loan to values. We require participation a lot of the times. And we have preferred payback terms or splits that make it very advantageous for our investors. So in each of our deals. And here's what the projected returns are. This question was asked earlier. And we have a class A and a class B for larger investors at 250,000. But conservatively, we're looking at that kind of 2 to 2.5x over the course of, it's different than a real estate deal where real estate deals, maybe they just say like, we're going to buy it and sell it. This is highly diversified. This is like buying and selling thousands of things in our fund, right? So you're going to have a bit of a bell curve, right? Where some of them, the timing is in the middle as expected, and some of them are a little lagging. And so that's why we say, kind of peaking. We say it's starting in years 2. And in our case, we're happening a little earlier with the sexual assault right now. Peaking in years 3 and 4, as we've underwritten, and tapering in years 5 and beyond. There's always going to be some stragglers. We have the ability to exit potentially some of those if they go too long. But we're looking at more of a middle loaded distribution of capital. So there's no cash on cash return per se. It's more a quarterly distribution as settlements come in. You can't predict exactly when the settlements happen. Well, you can't predict real estate either. Nothing is really predictable. But in this case, what we do know is those returns are not going to go up or down with a crash in this market, with a crash in real estate, or with a crash in oil and gas. It allows you to go to sleep at night, a little more confidence. You've got a piece of your pie somewhere else outside of all these volatile markets, so you know something's coming back to you outside of all that mess. So our sensitivity tables demonstrate a resilience to our estimated collateral values, right? Because like in real estate, when you have a loan to value and have all this market volatility, typically that loan to value is 50, 60, 70, 80%. That volatility comes out of the borrower's pocket. In our case, we're much down like 10, 20, 30. A lot more volatility can come out of the borrower's pocket before it affects our capital. It's very interesting. Our sensitivity table shows even if we're off by like half, you still have a strong return of capital there. And we do have a split of the profits that is kind of typical for a waterfall approach. We give a lot more away to the investors early on, and then we take some more as the fund outperforms, like above 30% returns. We get to participate a little more, and that gives us a little more alignment of interest. And we do have some limited subscriptions for promotions. We actually have some really exciting new cases that aren't on here that we want to get into quickly. And keep in mind, we're very late staged. So when we started at Camp Lejeune, since then they've shut that case down and you can't add any more payments. And then we started in the sexual assault, and then they shut the juvenile one down. We're so late stage that we're trying to hammer in as much as we can before they shut it down. Right now we have some really exciting ones. That's why we're out here today talking about it. If you want to jump in, we're actually providing some promotions on a higher preferred return, which gives you more downside protection, and a higher split of the profits, which gives you more upside as the deal overperforms. Trying to get that to go there. Let's see.
Patrick, just to confirm, what you're about to describe is not active open opportunities, correct?
It is.
So compliance-wise, Advanta, we're not allowed to have you share an active open opportunity that's available. You could certainly reference it and have people follow up to you directly on your channel, but just for the purpose of this educational webinar, it cannot be an active opportunity for them to come jump into on this channel or on this platform. And that would be something I'd have to defer them to reach out to you directly, one-to-one, and so forth after the fact. Sorry about that. Okay. I thought that was kind of cleared through our compliance.
Sorry. Yeah. But so reframing. This are typical of returns that are available in litigation funding, late stage litigation funding, diversified portfolios. They're tax efficient in a way in which the majority of our returns come back as capital gains as opposed to interest income, which is interesting for a lot of investors because they don't like interest income because it comes back as like ordinary income, right? Well, our funds using a prepaid forward structure, which with some of these funds can use a prepaid forward structure, which allow you then to be able to realize that gains as capital gains, which is a lower impact on you. You know, it's 20% versus like 37.
And we are also up against it at time. We're about 1:04 p.m. So if you've got a few final points to
That might
make,
be the end.
and
Okay, we probably got
okay,
to skip these slides. So I think that's it.
okay. Well, let's
There.
advance through to our slide with our contact information here.
Okay.
We'll leave it on this one for yourself and for David.
Mhm.
So again, great pieces of information here. Not only did you cover the litigation financing side of things, but you also cross-compared a lot of different asset classes that people are maybe aware of and not too familiar with. I think it was a really great cross comparison, and then diving deeper towards the latter half of the presentation into what even is litigation financing, how is it obtained, how is it processed, and what is the timeline, things like that. All really great pieces of information I don't think we've ever covered on these educational webinars. So thank you so much, Patrick, for coming on and sharing all this information with us. To the audience, I've got Patrick's contact info here on the screen. As he was mentioning and teasing you with a little bit, he's got some active opportunities. You can reach out to him directly to check those out. Any final parting words or keynotes or takeaways that you'd like to share with the audience, Patrick?
Yeah, I give away, I have two things that I give away, and I'd be happy to offer them to your audience. One is I have a handout, a PDF, which is Patrick's favorite alternative investments that anybody can invest in today to start building non-correlated stability in your portfolio. People, my most common question that's ever asked me is like, so you talk a lot about, getting into novel, lesser known asset classes. How do I do that so I can start having a portfolio truly diversified that has pillars of foundations that are not riding the same waves? And so I investwithpatrick.com, investwithpatrick.com. You're going to see that it's a downloadable, and it's a list on the first page, and then in the subsequent pages I dive down into each of them and I describe my understanding throughout my journey of each. The other thing I would say is we have an alternative investing mastery series. Just like Advanta, we very much value just the blue ocean approach to introducing investors to every kind of all different alternative asset that's out there. I was an engineer, hardworking machine design, automation, robotics guy, like many of you, high paid professional, and I had no idea where to go, how to invest. It was a complete unknown world. And just in the last 10 years, 20 years was I exposed to this huge world. So I started showing my hand to people, and they really liked it. So we created a webinar series, the Alternative Investing Mastery Series, where bi-weekly we dig into completely different alternative assets. And during that process, people get exposed to every kind of different way to invest. And they get introduced to other operators. They get introduced to other strategists like tax strategists and people like Advanta. So I'd be happy to invite everybody there. It's passiveinvestingmastery.com. It's what I had when I was starting out, and I think you need it too. And it's an educational platform, broad spectrum. Passiveinvestingmastery.com. The Alternative Investing Mastery Series right there at the top. I do give away a free book as well, passiveinvestingmastery.com/book. You have to put where you heard about that from, though, in the promo, because we don't send it out if we don't know where you came from, if you're just a random. So make sure you put Advanta IRA inside the promo code on that form. But passiveinvestingmastery.com/book. It was an Amazon bestseller. It talks about my whole journey. A couple other people did some chapters. It was awesome, really cool project. And hopefully it inspires you along your journey. And if you set up a call along the way and I get to participate on your journey, I'd love that.
Awesome. Thank you. Thank you so much, Patrick. Again, to the audience, if you are participating with us live today, thank you so much for cutting some time out of your Thursday. If you are looking for a copy of today's presentation, this will be uploaded to our YouTube page within about 1 day, and everyone that registered for this presentation will receive a copy emailed to them directly. So you could find it on YouTube, or you could just wait for that email to hit your inbox. You could watch this back at your own pace, and feel free to connect with Patrick and or myself if we can help you with anything further. Thank you all very much, and have a wonderful rest of your day.
Thanks for having me.
Of course.